Before we kick off today's episode of Macro Mondays, if you would like to take your trading career to the next level, Onyx Institute, my online trading course where you can learn fundamental and technical analysis of both the energy and financial markets, will be live and available for you to sign up and watch from next month. So please keep a lookout for that at onyxcapitalgroup.com. And if you have any questions or queries, you can email me at onyxlnd@onyxcapitalgroup.com. Hello and welcome to another episode of Macro Mondays. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Again, lots to talk about this week. We've had a bounce in equity markets last week. Gold sold off hard and euros sold off as hard as well, with the dollar bouncing on an ease in tensions on the tariff disputes.
Looking at global manufacturing, things aren't looking too pretty there as global manufacturing data comes in weak over the past couple of weeks. And US consumer confidence similarly at record low levels. And all of this in context, we've got a big week of data coming up. So we'll be discussing all of that going forward.
If we start with the tariff disputes, it's hard quite which headline to start with. Really, it all turned around on Tuesday. Donald Trump and his team took a step back from the brink with China. Trump said tariffs on China will not be as high as 145%. And he also stepped back from the pressure he was putting on Fed Chair Powell. He said he had no intention of firing Powell. So equity markets rallied, the dollar rallied, and gold sold off. He also said we're very close to a deal with a war on very close to a deal on the war in Ukraine. And what he's clearly doing here in his team, they're jawboning. They're trying to talk up the sentiment. He's come out over the week and said when tariffs cut in, many people's income taxes will be substantially reduced, maybe even completely eliminated. Again, trying to talk up good news. But the reality is, Treasury Secretary Bessent said US trade deal with China is 2 to 3 years away. China came out the weekend and said it's considering suspending its 125% tariffs on the US goods, which is good news. But this morning, China's foreign minister has said President Xi and Trump did not have a call recently, and we are not engaged with trade talks with the US.
Yeah, it's quite apparent here that, it's clear as mud. There's a lot of hot air blowing, and it's hard to tell what the truth of the matter actually is. And I think you're very right to be skeptical here in these scenarios of saying, things are going to be amazing, the tariffs on China will not be as high, and yet on the other hand, the foreign minister saying there hasn't even been a phone call between President Xi and Trump. So I think Trump is very much trying to sort of, in a trading term, talk his own book here. And this headline about being close to a deal on the war in Ukraine, my understanding is that they're not actually particularly close to a deal on a war in Ukraine. And I think this is really Trump trying to pressure Zelensky to come to a deal that a lot of independent journalists are saying, favors Putin quite a lot. The deal that they're purportedly discussing at the moment states that Ukraine would abandon any claim to Crimea and other regions that have also been, annexed by Russia. This is something that Zelensky, fundamentally does not want to do, but Trump saying we're close to a deal puts him on the back foot and puts him under pressure, because in the court of public opinion, if Trump says this and people believe it to be the case, then Zelensky will be seen as a troublemaker for not accepting this deal. So Trump is really sort of suiting his own agenda here by saying we're going to be making, diplomatic decisions on tariffs and we're close to a deal in Ukraine, where in reality, I think, he's not playing ball, and it's not the case.
And also he's talking up the economy and what he's saying, but we're seeing, as we'll see shortly, there's a significant deterioration in economic data. And this week we have a huge swathe of data from first quarter GDP, which of course is largely irrelevant now. We have PMIs, CPI, and we also have on Friday US payroll. So lots of data coming out. We have some central bank meetings, and the data is going to be pretty poor. We'll talk about what's happening with shipping and freight, but there's no good news coming out the economy, which is going to hurt Trump for sure. One chart I have here is dollar yen, and this is kind of a barometer of where the discussions are going. And you can see there's a clear neckline there at 140. We had a bounce, really came last Tuesday when Trump took a step back from the tariff disputes. But you can see that's a clear line in the sand. And what's interesting as well, we have a Fed meeting on the 18th of June, currently 16 basis points of cuts priced in. It's not going to be 16, it will be 0 or 25. As the data gets worse, I'm pretty confident they'll be cutting 25 basis points. And from a trading perspective, as soon as the 140 line breaks, support breaks there, you'll see a flurry of selling coming in, and you'll see yen buying and dollar yen and other yen crosses fall quite rapidly. Onto the euro dollar. Well, we're talking about the relief in the markets from the step back in the trade disputes. Euro dollar, it's stalled. You can see here, this is at the Bollinger Bands. It's a weekly chart. So Bollinger Bands highlights basically 95% of all price action is between the two bands. So it's only above the upper band 2.5% of the time, only below the lower band 2.5% of the time. And this is typically, once it turns, you typically get a mean reversion trade. So you can see the market was very short dollars. It went to the euro as a safe haven, but you can see now it's a crowded trade and we're getting some relief and a sell-off there. Similarly with gold. Question here, has gold peaked? Gold touched 3,500, and you can see we've seen a pretty aggressive sell-off. There's key support at 3,260. I tend to think as it's a crowded trade, the short-term trend tends to be down, but I think the longer-term trend will be up for two reasons. Firstly, going back, we know central banks are buying aggressively, but secondly, I think the data is going to get a lot worse before it gets better.
Yeah, I think it's worth noting, obviously, that one of the main reasons why gold did, perform so well over 2024 was it was momentum trading, and then it started at the end of 2024 to be, doubling down as this recession trade, etc. One of the reasons why now it's been coming off is because it has been performing. So people who've been losing, portfolio managers who've been losing have had to liquidate. But what you've now lost is the upward momentum. So you might find that it sticks into a bit of a range here between that recent low and the all-time high, as perhaps the goodwill, and even with central bank buying, you might not see quite the same retail trajectory to get it challenging new all-time highs.
Would you buy gold?
I still like it as a recession trade, and for that reason, I'd be happy to put money into it, and am happy to put money into it, but I wouldn't put money into it thinking that it was suddenly going to go to $4,000, etc. I just think if I'm personally less confident in equities, especially US focused equities, and therefore I like the sort of comparative, in my mind's eye, stability that comes with gold.
I agree. And the other point is typically a safe haven is US bonds, but of course in the current environment people don't want bonds. I also like gold, but not at the moment. The short-term trend is actually down. But this week, we're going to get data out when it starts to turn higher again. And this short-term, the recent move is more about positioning. When the positioning's been unwound, it will start to trend higher again. That will be the time to get back in my view. Back to the data. We've had weak US data. Some of the regional Fed surveys have come out particularly weak. Fairly Fed manufacturing business outlook fell 39 points to 26.4, second lowest level since the 2020 COVID crisis. The Philadelphia Fed Services Index dropped to minus 42.7, lowest again since 2020. New orders again, lowest since COVID. Also, you can see from the chart here, March leading economic indicators from the Conference Board fell 0.7%, fourth consecutive decline. Largest drop since October 2023. And if we jump one chart forward, you can see here leading indicators divided by lagging indicators. That ratio on the next chart, yeah, that shows that typically whenever we're at these levels, we would be in a recession. That's one reason why I think we're going to move towards a cut, at least 25 points on the 18th of June.
And what are the leading indicators versus the lagging indicators?
Leading indicators, typically forward-looking indicators like ISM, Institute for Supply Chain Managers, PMIs, Purchasing Manager Indices, that are surveys asking what your intentions are. Lagging indicators, the data backward-looking, for instance, GDP. Perfect. So again, we have first quarter GDP coming out this week. Again, it's largely irrelevant because what happened January and February and March is completely different to April because of this tariff dispute and Liberation Day.
Yeah.
One point as well with June as well, if they're pricing in 16 basis points now, there's a chance on weak data the market starts to price a chance of 50 basis points cuts. If the economy is as weak as we'll show it is, with consumer sentiment close to all-time lows, then why shouldn't the Fed front run the cuts?
Cut further, yeah.
Global manufacturing is falling aggressively. Flash PMIs last week came out much weaker than expected across the board. Note, these are diffusion indicators, above 50 expansion, below 50 contraction. Germany, the composite, so services and manufacturing, composite PMIs came in at 49.7, a fall from 51.3. France fell from 48 to 47.4. A disaster in the UK, falling from 51.5 to 48.2. Note, UK manufacturing PMIs at 44. That's deep contraction.
It's really bad, yeah.
And US composite PMIs still in expansion, but again, a big fall from 54.4 to 51.4. Chart here, you can see the 6-month outlook for new orders and for employment for the Richmond Fed survey. They both fell in contraction. And you can see from that chart just how aggressively they're falling as well.
Yeah, to see all of these European economies having their composite rates, being sub 50, i.e. definitely in contraction. And even the US, if we look at the US composite data, to have it coming in lower than predicted, it's really worrying, especially with the context, as we said, of new orders in the Philly Fed. It's looking, the uncertainty is really damaging.
It's important as well because we typically have a bias looking at US data because it's over a quarter of a global GDP. But again, as you say, it highlights European data. And also on that, we have in June, we have the Eurozone meeting on the 5th of June, the market's expecting 25 points cut. And Bank of England on the 8th of June, interestingly, the market's expecting 27 basis points of cut. So the market's looking there at the Bank of England, the chance of 50 basis points is being priced in the overnight index swap market. And you can see consumer confidence has absolutely collapsed now. So the chart, consumer sentiment here, families with an income over $100,000 and families with an income less than $100,000, both have collapsed. US sentiment is now lower than in the financial crisis. At 50.8, it's the second lowest level in history ever. And it's the lowest level in the last 50 years. So it's catastrophic. People won't spend.
Yeah, and if you're looking at this term, sort of spending your way out of a recession, it's not going to be coming from the consumers at all. Consumer confidence is absolutely through the floor. If you're looking at any significant outlays for you and your family, you're not going to be doing it now. Tariff uncertainty is absolutely up there and playing into this, but everything, all signs are creaking. So yeah, it's looking very worrying.
Also, we're heading into US driving season. So from a gasoline perspective, do you think this will have any impact?
Well, I mean, I think what you would perhaps see is with Trump and his rhetoric, being so low energy prices and low gasoline prices, that you're not necessarily going to see an inflationary impact of this spending. And also people are probably, they're far less likely to be taking summer holidays. People will be feeling the pinch. And I think you could see, even if gasoline prices were to be enabled to be lower because of policy changes, you're not necessarily going to be seeing an increase in demand to make up for that in terms of a total expenditure on gasoline. So, yeah, I think it might be a quiet summer for a lot of US consumers.
Interesting. And what will also be interesting is retail sales going forward, because of course, if people are going to have their hands in their pockets and not spend, that will hurt retail sales. Again, important then looking at retail sales to focus on value and volume, because with inflation ticking up as we're seeing, sometimes retail sales, the value is going up, well, actually volumes of goods is falling. So on to another topic now that's gaining traction is the collapse in the freight trade from China to US. Bookings for container ships almost immediately collapsed straight after Liberation Day. You can see here the drop, week over week drop in ocean bookings, 49% drop in global TEUs booked. TEU is a 20-foot equivalent units, container units for shipping. Overall US imports down 64%, exports down 30%, US imports from China down 64%, exports to China down 36%. This is catastrophic for shipping. Also, one important point as well, it takes 25 days from containers shipping to go from China to LA, 35 days China to New York. So the impact hasn't been seen at US ports yet. So there'll be a knock-on effect with the transportation haulage companies.
Yeah, absolutely. I mean, freight is it's one of these things with a huge lead lag time. You know, getting stuff from A to B in these huge economies does take a while. And so even though, you know, we're now, 25 days since Independence Day, publishing on the 28th, that's almost bang on. In the best case scenario, you'd be having one of your vessels making its way that's departed China, mainland China, on the 4th of April, arriving today. So in reality, even if we're talking in hyperbolic terms about how disastrous things are in the US and how expensive things are going to be, hasn't even begun yet. You're only going to be starting to see any of this uncertainty in terms of exports being booked coming in over the next month, 2 months, etc. And although uncertainty in policy hasn't necessarily changed things on a financial basis, the uncertainty in terms of what is exported will be.
Yeah, I'm reading more and more that late May, early June, you're going to start seeing empty shelves in the US for certain products. Also, I'm reading that the fall in shipping is similar to COVID levels, but the difference is, of course, ships are moving, and what corporates in the US will do, they'll only pay up for the goods they desperately need. So on that, China's supplies of the raw materials for final assembly of products in the US. So transportation purchase of plastics from China, US has fallen 46%. Copper purchase has fallen 31% and wood purchase has fallen 24%. And you can see from the chart here, corporate capital expenditure plans continue to fall. So again, this is just bad news for the US economy. It's going to be knock-on effect, bad news for hiring. Unemployment will tick higher and the central bank's going to have to cut rates. That's the only way out of this one, I think. And I mentioned transportation, haulage companies. Here is a chart, North American Class 8 trucks. The inventory, you can see it's going up. This is going back to 2000. Inventory of trucks is well above financial crisis and COVID levels. And what's going to happen was ships are still arriving with goods. In a few weeks, they won't be. Then the ports are going to be empty and there's going to be a lot more inventory of trucks and unfortunately layoffs. Important point here is Donald Trump said he's going to support the farmers, but shipping and supply chain in the US is nearly 3 times larger than farming. So there's going to be big job losses there. And again, it's going to hurt the economy. Central bank will have to cut rates. US bond market had some relief last week with the step back of Trump on China. Funds posted, Treasury funds posted record 19 billion inflows last week, surpassed the previous peaks during COVID pandemic. Meanwhile, 30-year Treasury yield is down nearly 30 basis points from its April high. So good news there. I still think the curve will steepen. Here we have a chart of the 2s, 10s. I think the curve will steepen because simply the central bank will have to cut more aggressively at the front of the curve. And also we have raising inflation, which will steepen the back of the curve. Inflationary pressures rising. SHEIN over the US hiked prices up to as much as 377%. I'll read what they've said. The average price for top 100 products in the beauty and health category increased by 51% from Thursday. Several of the items more than doubling in price. From home and kitchen products and toys, the average jump was more than 30%, led by a massive 377% increase in the price of 10-piece set of kitchen towels. Don't know if you're buying any kitchen towels soon.
No, it should be front loading. But, you know, this is a particularly interesting example because I think the reaction to this news is very much, oh my gosh, look at tariffs, how disastrous are these? But this is the sort of thing that I think Trump and his fellow policymakers were particularly keen on. They see unfair labour market conditions in particular playing a role into the Chinese manufacturing of cheap clothes, which a company like SHEIN does. And I'm not sure that the popularity of SHEIN amongst many sort of ethical consumers, they don't hold SHEIN in particularly high regard. There are often questions about the sort of physical conditions that their workers are being put in, etc. So to see them having their comparative advantage produced by perhaps unethical manufacturing procedures, you know, would play into Trump and his supporters' view of what should be happening with the world economy. The question, though, does become, can people afford to have ethics in their consumption? Because, you know, if people are being squeezed so much, they will, regardless of how things are being produced, they will go for the best option if they can't afford the alternative. So it's bad for conspicuous consumption, and that will sort of drive down. But is it going to affect the bottom line consumption? Very possibly.
And the chart here highlights Fed manufacturing surveys, the prices paid, the regional surveys, and also PCE, personal consumption expenditure, prices paid. You can see it starting to go up as aggressively as the start of COVID. I've mentioned, I think the Fed will have to cut more aggressively. Typically, they won't cut into an inflation environment. They want to prevent inflation. But if the economy is stalling, they have the dual mandate. One side is growth, the other's inflation. The inflation we're seeing here isn't demand driven. It's being pushed by supply chain, and Fed raising rates to prevent that won't have any effect. And that is, again, why I think the curve will steepen. So US recession is looking more likely. Even Bridgewater, largest hedge fund in the world, has turned very bearish, highlighting the sharpest decline in earnings outlook since 2020, new orders collapsing, sharp reversal in corporate capital expenditure spending plans, prices paid rising, and consumer confidence at record lows. We've seen a bounce in the NASDAQ. You can see a huge move with what we had, still a long way from the 20,100 peak. What we're seeing over the weekend, Nvidia's under threat again. We'll have that chart up soon. But because we've seen a bounce in the prices, we're seeing CTAs, hedge funds, trend following algorithms. They've begun buying US equities again from a minus 26 billion net short position. They'll keep buying till the next wave of selling comes in.
Yeah.
So again, this supports a short-term bounce.
It's still, if we look at the chart there, though, it's still quite we're still quite far away from it sort of being a net long situation, isn't it? We're, you know, at this lower level, but I would have thought that people will start, you know, slowly adding length and reducing these shorts.
An interesting point here, this is driven purely by price action, not fundamentals at all. So that's why I think, again, we'll see some buying going into this week. The key data doesn't really kick off till Tuesday. Lots of data. Again, the market's buying irrespective of the fundamentals, as we'll see with Tesla again shortly. Again, record inflows into US equities. but the buy the dip mentality continues. US equity funds have seen a record 156 billion of net inflows year to date, tripled previous years and surpassed the 154 billion record in 2021. Again, the chart here, sharpest decline in earnings outlook since 2020. This isn't the time I'd want to be adding to equity positions.
No, absolutely not. And I think, when you see on the flip side, things that affect earnings and being consumption is, people are not looking to add to that. Whereas this buy the dip mentality in equities does seem to prevail, which seems that the two things seem quite, at loggerheads with one another.
And as we've seen recently, it tends to be the funds that are selling while the retail just continues to buy and buy and buy. Here we see Nvidia. So over the weekend, China's Huawei announced they've developed a new AI chip looking to match Nvidia. There's a clear double top there at $153. And from a technical analysis perspective, it's not something I follow the death cross or the golden cross, but you can see the 50-day moving average has broken below the 200-day moving average. Typically that would bring some selling in, but that's certainly not an uptrend, and it's a long way from the previous high.
No, and I think with Nvidia as well, a lot of people would have said, and I think it's fair to say, it was speculators' folly. People, group chats would be littered with people saying, oh yeah, of course I bought Nvidia, Nvidia only goes up. It was a very inflated price for that reason, but also because it was the only one, it had the comparative advantage in its chip technology. What we're seeing now is people are catching up. It probably wasn't feasible that it would maintain its preeminence as the sort of sole sustainable chip manufacturer. So to see this competitiveness of other chips is not particularly surprising, particularly off the back of what we've seen in the AI sphere with GPT losing its preeminence with DeepSeek and all of this.
Absolutely. And a good point, you talk about retail buying. We do a course on this. We have online training. We have more training coming up in Singapore next month. We do a course on technical analysis and behavioral finance. And what retail traders do, as you said, when the market's going up, they'll keep buying more. They'll talk about it on social media. But what they don't do is close the position when the market starts turning down. And that's what algorithms are very good at. That's what a rule as simple as trend following is very good at. When the market starts going down, you get out and you even go short. But what retail do is they hold on to their position and they start hoping. Just some updates on US home prices. Existing home sales fell 5.9% month on month. That's the weakest since March 2009. Also, the drop significantly worse than expected. Demand remains weak as house prices are near record highs while mortgage rates are above 6.5%. Separately, mortgage applications fell 12.7% last week. They fell 8.5% the prior week. It's the largest weekly decline since October. And finally, existing home sales fell 5.9% last month. So again, consumer confidence is low.
Yeah, I mean, one of the common themes that we're saying time after time in this episode is since 2008 or since 2020 when it came to new orders, these are two terrible, terrible economic catastrophes. The 2008 financial crisis, COVID in 2020 affecting everything. So if we're sat here saying the worst since then, it's almost like Man U being the worst, having the worst season year after year after year. Now it's getting to worst year they've had since, 1986 or something. Are we going to be looking at this saying oh yeah, I really fancy Man U for the title next year? No. So the US economy, very much the same.
I mean, consumers' confidence, the worst in 50 years.
Yeah, no, it's dire.
People aren't going to spend. The Fed needs to cut rates.
Yeah.
Moving to UK, some mixed data in the UK. Retail sales surprised to the upside, but consumer confidence, again, came in weaker than expected. All three subcomponents came in below their long-term averages. Savings was up. Again, not good for the economy. And the chart here is sterling yen, the currency, in orange against the interest rate differential. The 2-year sterling yields, or 2-year sterling interest rate swap minus 2-year yen interest rate swap, they're diverging. Again, that implies to me a good shorting opportunity. And again, the Bank of England will be cutting rates. Bank of Japan's actually hiking, but the market's scaling back what they're expecting, just 16 basis points of hikes this year. But we had Tokyo CPI came out last week, much higher than expected, and at a 2-year high. So again, divergence in interest rate differentials there. I'd expect to see sterling yen heading lower again soon.
Yeah, I think with UK it's sort of interesting because I think this is fair to say, with retail sales surprising to the upside, but consumer confidence coming in weaker than expected, it seems as though at worst it's mixed data, perhaps even slightly supported data on the demand side. But on the supply side, as we said earlier, the composite PMIs are looking very poor. And so to some extent, you would have to expect, people's demand inherently as workers comes from the economy's supply because they're earning their wage, etc. So if their job is going to be under threat in the long run because of weak manufacturing or weak services, then their long-term consumption and demand is going to be called in. So I do wonder whether the weak composite data in supply, in the supply side of the economy, is going to eventually feed into this demand side curtailing.
Another important point on that, it takes a long time to turn sentiment and the economy. If the central banks start cutting rates, there's always talk of a 6 to 9 month lag. But unemployment, for instance, doesn't go up and then suddenly fall back down. It's cyclical, and the sooner the central banks act, the better. Especially as well, because I don't think we're going to see, we're not even seeing the impact yet of the tariffs.
No.
That hasn't hit the data. So there's a lot of bad news to come.
Yeah, I mean, people I think are sort of fearing, and so you sort of have it playing a very small impact without the actual realities of the matter having affected people. So yeah, I think people are still yet to bear the brunt of what's to come.
Yeah. On to Brent. Brent struggles below the sort of 69 key support level. Todd, you're better than me on this one.
Yeah, I mean, I think it's an interesting story with Brent over the past week because, the hot air coming from the White House has given it a small amount of life here and there. That this stuff saying we're not going to be hitting China with the 125% tariffs, yada, yada, yada. And so those kind of headlines, you do see spikes in Brent. Even with this headline fatigue, there is support from these headlines, which, it's almost beggars belief, to be honest, because you also, in the very same day that it was announced, it was Wednesday when Besant did his speech, and it was announced that the tariffs wouldn't be as severe as people feared, and you saw this support in Brent. OPEC then announced that a lot of its composite members were just going to be urging more rollout of Brent and an increase in supply. Kazakhstan was one of the leading countries this week with headlines saying, they genuinely, as a country, cannot afford to abide by OPEC's guidelines. This is an open secret. They've been doing it for years and years and years, but they're saying that if we reduce production sufficiently to meet OPEC's sort of maximum level, then we're not going to be receiving enough revenue, bottom line, to be able to support our economy. So they're going to be increasing supply. A lot of OPEC countries are going to be increasing supply. The market is going to be flooded with barrels. And it's I think it's probably an environment where we could see some price action to the downside overall, particularly in the long run. And I'll draw everyone's attention to the next chart. This is Eastern gasoline. So this is the Singapore 92 RON benchmark, Singaporean gasoline, but it's also a benchmark for Chinese gasoline, etc. And we've seen some support in this Asian gasoline. I think partially in a comparative basis, you can see 92 Asian gasoline being supported against, summer US gasoline in this scenario. It's naturally the case that US gasoline is more expensive than Asian gasoline. But what we're seeing is countries such as Mexico having now, because of tariff uncertainty, to purchase gasoline from Far East Asia, from Singapore. This isn't unprecedented by any means, this does happen, but we've seen particularly strong buying from Mexico of Asian gasoline because they just, can't be pulling it in from New York Harbor or even the US Gulf Coast. So this provides support into other areas of the world in terms of the price of their gasoline. And similarly, even on crude, you're seeing Mexican barrels, they're not going to be able to export to the US as much. So I think you're going to be seeing on the world supply almost getting the US exempt, you're going to be seeing an increase in supply, which is going to have a negative price effect. But I would also, if we look at this Singaporean gasoline crack, which shows the relative strength, whilst it's been a strong week, if you see that white line on this chart here, so this is all available on Onyx's Flux trading platform. So whether you're an institutional trader or a retail trader, you can trade at Onyx on Onyx Markets. But if you look at this price rise is still very much within a natural range. If you sort of, with your mind's eye, exclude that 2022 price hike, which went abnormally high when the Russia-Ukraine conflict started, this 92 RON gasoline is still in a range that is very comfortable with. So if you fancied taking a punt and getting short, there would be years such as 2023 and 2024 where you would have made money by getting short Asian gasoline at these prices.
And with that, moving on to Tesla, some interesting price action there, and a good example of following fundamentals doesn't always work. Tesla had some bad earnings last week, a big miss. Revenue came in at 19.3 billion, expected 21.1, and earnings per share 0.27, estimate of 0.43, I should say. So a big miss, but you can see actually the price action jumped. When the market's sold off and there's no one left to sell and it can't go down on bad news, then it's going up. And you can see key support coming in at 217, but it looks like certainly buying coming back into the Tesla market. Elon Musk's taking a step back from Doge as well, so he's back there with Tesla. That market's one that's going up.
Yeah, it's obviously come off a long way, but we'll see what happens. I think it's probably a good thing for the Tesla stock price that Musk has taken a step back from Doge and just even a small bit of breathing room from him and this government, which is, whether you like it or not, it's a fact that it's a divisive government. I think it will be good for the Tesla share price that he's distancing himself.
Central bank pricing over the next 12 months. Well, the market's still looking for over 100 basis points of cuts from the Fed. They say June is big, 16 from the Fed, 25 from Eurozone, 28 now from the Bank of England. Busy few weeks, but what's more important really is the economic data that's coming out this week. On Tuesday, we have more consumer confidence from the US. Also, the job openings index, I expect that to be weak. House price index as well. Lots on Wednesday. China's purchasing managers index comes out. Eurozone CPI and GDP. Australian CPI, US Q1 GDP, PCE prices, ADP, and Canadian GDP as well. By far the biggest week of data we've really had all year. Thursday, we then have the BOJ rate decision, US ISM manufacturing, and then after all that, the biggest piece of data of the week, US employment report on Friday. We also have 25% of S&P companies reporting this week. So on top of the tariffs, it's a huge week. It's going to be a volatile one.
Yeah, and I think, as we always, since about November, we've been saying, keep an eye on the headlines, that can trump things, pardon the pun, in terms of importance. But I think one of the issues with headlines as well is it's so flip-floppy. Things can be reported and then reneged immediately almost. So there is money to be made, I'm sure, by looking at these headlines and trading them. But unless you're sat at your desk 24/7 holding these as short-term positions and chopping in and out, I'm not sure I'd necessarily look at these headlines and read into anything too much. So I think I'm starting to flip to the mentality of put your fingers in your ears regarding what the latest is going to be on tariffs and start to look at the fundamental data. And then at the end of the week, come back to Macro Mondays and see what we're saying about the about the reality of the tariffs.
Yeah, absolutely. You're spot on. The jawboning is just narrative from the Trump administration, and they're trying to talk up sentiment, but the data's actual fact. And I can't see anything but the data getting weaker immediately with what's taking place.
Agreed.
And what we will do, we'll be providing daily updates. We've been doing this regularly now on LinkedIn on our page, Onyx Institute. So each morning by 9 a.m, there'll be daily updates again on Onyx Institute on LinkedIn. You can also find on there and on the website the training that we're doing, L&D department, we're doing training, face-to-face training and online. So please do follow that. We have a bank holiday next Monday. We will be recording Macro Monday late on Friday after all the data's come out, so we can give you a timely update. And have a good week. It's going to be a busy one. Good luck and thank you very much.
Thank you.
The true heartbeat of the global economy, the financial oil market, has remained out of reach for most until now. Introducing Onyx Markets, the first platform to bring personal investors into the ecosystem that sets wholesale oil prices around the world. This is where the real economics of energy begin, a market that shapes so much of our everyday lives. Onyx Markets levels the playing field. Access live, tradable numbers from the industry's leading provider of financial oil market data. Whether you're a personal investor or a global corporation, low cost, transparent, and empowering. For the first time ever, you can trade global oil benchmarks like dated Brent, Northwest Europe shipping fuel, and US Gulf Coast propane through spread betting and CFDs. Hedge with precision, trade tax efficiently, and gain unparalleled transparency. Supported by the world's largest liquidity provider in the financial oil markets, Onyx Markets also brings you insights from industry-leading analysts, detailed reporting, and expert-led education to help you navigate this market with confidence. Onyx Markets, the power of the financial oil market now in your hands. Start trading today. Visit onyxmarkets.co.uk.
Thanks for watching. If you would like to take your trading career to the next level, Onyx Institute, my online trading course, where you can learn fundamental and technical analysis of both the energy and financial markets, will be live and available for you to sign up and watch from next month. So please keep a lookout for that at onyxcapitalgroup.com. If you have any questions or queries, you can email me at onyxlnd@onyxcapitalgroup.com.